You've worked hard, built a solid property portfolio, and now you're ready for the next phase of your life, retirement. But here's the big question. Should your investments also retire when you do? Too many Australians assume retirement is the finish line for wealth creation. They think it's time to play it safe, park their money in term deposits or something like that and hope for the best. But in today's world where people are living 20 or 30 years beyond retirement, that approach could actually do you more harm than good. So today I'm joined by Australia's leading property and wealth tax strategist and my good friend Ken Race, Director of Metropole Wealth Advisory. And whether you're approaching retirement, you're already there, or even if you're nowhere near it yet, you're going to walk away from this chat with some clarity and confidence about how to set up your property and investments, because we're going to explore what it means to keep your money working for you in retirement, how property investors should adjust their strategies, and what you need to consider beforehand to get to that stage in your life that you're going to start living off your portfolio and not just eating it away. So let's get on with today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi Ken, it's always good to have you on the show, and today I want to tackle something that I think many people underestimate. Retirement for many of the clients who come to Metropole, or for just property investors in general, seems to be where they're talking about the end of the journey. But in reality, it's just another chapter in the long story of life, isn't it, Ken?
It certainly is, and given how long you're going to live after retirement for most people, it's almost a lifetime again.
Well, you're right, because in the old days, people used to retire at 60. They worked physically. They didn't have a long life afterwards. And I guess that's why they came up with a retirement age of 65 or 60 and why the pension was only going to see you through a few years. But now the average age, men live till middle age. If you get to 60, they live another 25, 30 years, and women even a little bit longer. So I guess you've got to plan for that, Ken.
You certainly do. And people used to plan for, am I going to be bored in retirement?
Yes.
You know, all of a sudden your 9-to-5 job or whatever it is stops. It's what do I do when I wake up the next day? I think people now are realising am I going to have enough money to see me through retirement and maybe leave a little bit of a nest egg for the grandkids or the kids?
So in today's show, even if you're watching this, listening to this, and you're not nearing retirement age, please hang around. Please stick with Ken and me, because what we're talking about is how to set yourself up to enjoy your, well, it used to be called the golden years. Maybe it's the silver years now or whatever, because many people are going to be living, well, as you said a minute ago, Ken, almost as long in the post-work era than they will during their working years.
Correct. It's a substantial time. I mean, they call it longevity risk for those economists out there. And that's really how long are you going to live?
Well, interestingly, a lot of investors don't have a strategy, don't have a plan, and then don't actually plan how their assets are going to work in their retirement years. Similarly, they don't have an estate plan or passing on assets to their family plan, something we can talk about in a moment. But I think a lot of investors believe they should move to low risk, low growth assets in their retirement. But I know you recently wrote an article about this, Ken, where you thought that could be a dangerous strategy.
It is. I mean, people for a long time relied on Social Security, Centrelink payments.
Yes.
And I think people are fast realising that in itself is a risky strategy. And while the government may not be actually reducing the amount they pay you, they may not be increasing it at the rate, which is effectively giving you a cut. So
with the inflation, which is not going to go away.
Correct. So I think the way people have been brought up, it's de-risk. I mean, humans start off with, I'd rather not make it than lose it. So
yes,
people start off with de-risking. They want to minimize the downside as they approach retirement or in retirement because they don't want to lose what little bit they've got. And unfortunately, that strategy begins the digging of the hole. Because
Interesting.
given that most people are going to live another 30 years at retirement, 25 normally to 30, they've got to have appreciating assets that will, in fact, outpace inflation, because the costs that most of us will encounter in retirement will be above inflation. The medical, just to give one example.
Yes.
So we've actually got to do better than inflation, even to stand still.
So how does this now, living into your 90s, change the way you think retirees or people, well, before the retirement years, set themselves up to invest and manage their wealth?
What we're seeing is more and more people are starting to think about this at a younger age.
So they should.
Yeah. So they don't wait till I got 3 years before I retire. Oh, what do I do now? Because while you can soften the blow at that age, you don't necessarily improve. So people need to start younger. They need to start setting funds aside for capital growth assets. That's one of the reasons I like property so much. It's because a little bit of my money is leveraged with the bank's money to buy a bigger asset, and that's what grows over time. So you really got to start thinking strategically to ensure that you've got different cash flows coming at different times in these last 30 years, so that as one dwindles down, you've got another bucket, so to speak, to tap into, and then another.
Sure. So while we are biased towards property openly because it's a great asset growth strategy, a form of investment, and as you say, mainly because of leverage and also because you can outperform the averages, which is harder to do in the stock market. I know that at Metropole Wealth Advisory, you and your team discuss the next stage, and there's even some people who need financial planning advice. And by the way, this is not personal advice. There's always a disclaimer at the end of this show, but I should make it clear that Ken here is not speaking as either an accountant, which he is, or with financial planning qualifications, which he has. This is general information, but people need a mixture of assets and they need cash flow as well, whether it could be shares, ETFs, bonds, property, commercial property. So you can't just go into retirement in general with property only unless you have a very large asset base that's giving you enough cash flow. I think that's one of the lessons I'd like to get across to people, that they're going to need a much bigger asset base than they think they do to get through those years, Ken.
They do, because we don't know the troughs and the peaks, so to speak. And we do know that, particularly in the share market, there are large drops that take a few years to see themselves through to the next peak. So property is almost like a smoothing asset class when you're mixing it in with shares, because we're seeing that for an investment grade property, not just any property, an investment grade property, that they will fall when the market turns, but they tend to pick up relatively quickly. So in the scheme of things, that drop off seems to be significantly less than we see in the share market.
So having a mixture, is that what you talked about in your article, which I'll leave a link to in the show notes, about a bucket strategy?
That's right. And I call it a 3-bucket strategy. So one bucket is to cover those immediate cash flow expenses. And for some people, it's 1, 2, maybe 3 years. So that's what happens if the proverbial hits the fan and you're running out of money because of whatever reason. So you need that immediate bucket to tap into. The second one is your income, your living money, and that will see you through the bulk of the time period. And then the third bucket, to me, is the critical one. That's where you have growth. So it's money you don't need today or in the immediate future that you set aside to grow. And that's that bucket that will see you through age 70, 90, etc.
Well, that's interesting, because I know a lot of financial planners actually talk about building an asset base and just living off it, and you hope your money doesn't run out before your life does. That's not relevant anymore. And I guess one of the other things that doesn't take into account is inflation. That's a big risk to retirees, isn't it, inflation?
It certainly is. So we've got half the economy hoping for low interest rates. They're people with debt, and that's the one we see splattered over all the news. We see the Reserve Bank talking about lowering inflation and therefore lowering interest rates. But the other side of the coin is the poor retiree who has a portion of their funds in cash where they're living off interest. So for them, they don't want to see low interest rates.
No.
So inflation eats it up. And this is a lovely concept called the rule of 72. It's how long does it take an asset to double? So with inflation at 3% if we're going to say that's the long term, although I think it's going to be higher, but even at 3%, that rule says that your money will halve in value in 24 years.
So $1 million today will only buy you the equivalent in 10 years' time, in 24 years' time, of what $500,000 would cost buy you today.
Correct. And then you lower it, stage 2, which is I've had to spend some of my money, so that reduces it. And thirdly, I'm probably spending money in areas that are growing at higher than inflation, particularly when we're talking about medical expenses and things like that. So all of a sudden, in that 24 years, 25 years, you could end up with nothing. So those last few years of your retirement is going to be, well, what will the pension give me?
So therefore, it's important to have an asset class in your buckets that actually inflation helps, and property fits in there, doesn't it?
Correct. And I see property as a forced savings discipline. I mean, shares, you can sell a few, interest, you can tip into the bank account. Property, because it's a lumpy asset, which is, one of the negatives that people say it's a lumpy, large asset. You can't sell a bedroom, but it forces you to retain it until it's absolutely necessary for you to maybe sell it and convert it to something else.
Sure. And a lot of people don't want to sell. They want to pass it on
Correct.
to future generations anyway. But I guess what one has to consider is all these things early in the piece, including in which structure you own them. Now, we know over the next 30 years, as people retire, in the next 10 years, we're going to have some ups and downs. We're going to have another recession at some stage. We're going to have multiple changes of government. We're going to have tax systems that keep changing. We won't know what the banking system is going to do. So in my mind, apart from owning the right assets, you've got to own them in the right structures that give you flexibility.
I think 3 things. Flexibility is paramount.
Yes.
Asset protection, I think, while I'm maybe at the other end of the curve where I'm very pessimistic about, what happens if someone sues you. Australia's sort of within the number 2 or number 3 most litigious country in the world. So people who don't have want to take yours. So asset protection for me is critical. And the ability to pass it on to the next generation. So I'm not a ski enthusiast, and I know we're currently in the winter months. So I'm not talking about snow skiing. I'm talking about spending the kids' inheritance. So I want to generate a large enough asset base that I have a comfortable lifestyle, which means I've got cash to help the family, and then have enough to leave to the next generation. And that's why it's very critical to own your assets in the right structure so you can tick those 3 boxes.
Now, that's always difficult when you're first starting off your investment journey, when you worry about tax deductibility, tax benefits, the right ownership structure. Oh, that's 70 years away. I don't have to worry about that. But in fact, you can't change the ownership structure down the track without going to quite some expense. So having said that, that's one of the reasons why everyone who comes to Metropole and we put a strategic property plan together for them to help them develop the financial freedom they're looking for, they see one of your team members as well to get the right ownership structures in place. But what would you say to somebody who's now thinking, 10 years ago, 15 years ago, I actually bought in my own name, or 5 years ago, it doesn't really matter, and I've actually made a mistake. I've actually exposed myself. Now, the reason I'm saying this is I know there's been a couple of people that we've been working with together who are in that position. A couple of them were medical practitioners, others were other professionals. And I know you've got an answer, so it is actually a loaded question, but is there some way of protecting and helping people if they did it wrong early in the piece? It seemed the right thing at the time.
That's right. And it could have been the right thing at the time because their accountant didn't have a wide enough vocabulary and experience, or they were trying to minimize their land tax, or trying to maximize their borrowing capacity.
Yep.
Just didn't go and find out. So lots of reasons why people do. But at a certain stage in life, then people, and some people, say, I'm now worried about. I've become an owner in a business. We're seeing more litigation, frivolous litigation, where maybe a small incident in the shopping centre car park, and the list goes on and on. So how to protect those assets that you've got in your own name, including the family home. So we don't want to move everything into a trust and trigger capital gains tax and stamp duty, the loss of the main residence exemption. But there are strategies to protect that wealth that you've created without triggering those taxes.
Now, clearly we can't discuss them here. We don't know the individual listeners' and viewers' circumstances. But if you're interested in finding out about this, go to metropole.com.au. I'll leave a link in the show notes. Just leave a request to have a wealth discovery chat. But when you speak with our wealth strategist, please explain this particular concern that you've got, and they can organise a time for Ken or one of his team to speak with you. So metropole.com.au. Now, Ken, in retirement, a lot of people aim at having no debt. That's actually not my personal aim, and I'm actually happy for still have debt. And people say, but you're going to pass it on to your kids. It's actually not the debt that's a concern in my mind. I want in retirement from my properties to be at least self-funding. You don't want non-tax deductible debt. What's your feeling about debt or reduction in debt during the retirement stage?
Well, a lot of us have heard of that concept of good debt and bad debt, productive debt, non-productive debt. So productive debt is what's helping your wealth grow. And with that power of leverage, a little bit of your money with someone else's money, the banks, then you end up with a larger asset base. So you've got to make sure that you can cover the interest, expenses, and other things. So I'm not so much worried about that debt, but it's the non-productive debt. So typically we're seeing more and more people moving into retirement still having debt on their home. And that's because they've second marriages, something's gone wrong in life, they've upgraded too much. So those people are really at the pointy end. And we need special care to see how do we manage that debt while still maintaining an asset base that grows, while the equilibrium is I've still got a reasonable retirement. Because if you use your assets that are generating income to pay down your debt, you've now got a home maybe that's fully paid off, but no income other than Centrelink. So there's a balance there that we help people achieve.
So I guess the theme coming through all this is you can't just adopt a safe, I'll just live off my assets and eat them away strategy. You've actually got to be much more proactive about this. What are some of the big mistakes you see investors make when they are getting towards retirement stage, and things that they can avoid if you now give them some hints?
Look, I think the classic, and I've got to be careful because it's my profession. If they've got a few properties, they get convinced to sell properties and invest in managed funds of some sort. Now, if selling a property is a good strategic decision, you do that, but not just to put it in a bucket where someone will earn money. I think a lot of people with property maintain it. So property is like a living organism that needs a health check every now and again. And that is the cosmetic renovation at its minimalist. That ensures that you maximize your rents, your rental yields. It means that when one tenant leaves, you quickly then find another tenant. It means the equity's growing. So that means if you had to sell, you're going to get the best dollar for it. So people sort of even treat property as a set and forget, which they shouldn't. They don't go to the right property managers to maximize the best rent. They actually don't have a plan of how am I going to survive for the next 30 years by mixing my assets with my income needs. And that's a discussion you have to have the sooner rather than later.
Sure. Many listeners and viewers of this are going to want to help their children financially. Some of them at this stage, others later on at this stage to get into property. How should they balance this with protecting their own retirement? That's always a bit of a challenge, I've found.
It is, and I'm a grandfather, but my adage is you've got to look after yourself first. It's like when you're on the plane and they tell you when that oxygen mask comes down, fit it to yourself before you give it to your children. Yes. Because you have to survive. So it's understanding how to help your children, and the bank of mum and dad is almost the bank of grandfather and grandmother. So
It is now, yes.
I've always told my clients that if you're going to help your children into property with cash, it's got to be on a loan. You never know what's going to happen in their life. They could get together with someone, split, and then all of a sudden, the money you've given your child ends up going to the in-law, so to speak. So
Mm,
write it down. Talk to your children about getting them investment savvy. That's the best advice I give my clients. If you weren't
yes.
investment savvy and therefore needed that additional help, and we get clients with, many, many tens of millions, if not hundreds of millions of dollars worth of wealth. They still need the tune up, so to speak, how to operate what they've got better. And unfortunately, few families push that down to their children. So it's get your children financial savvy as well as part of all this. Have you got your wills in place? What are you doing for super? I had a sister-in-law call me. Unfortunately, my wife's brother passed away a couple of years ago and left a lot of money to the children, predominantly out of super. And then she was worried when she saw the tax man took such a large amount of money of tax out of what they thought was going to be tax-free. So
Wow.
she rang me up to say, how do I not make that same mistake? Because you've got to be careful which assets you give to which child, because different assets have got different tax liabilities attached. So you need to speak to someone who's got a very broad knowledge base that can help you understand the tax, the accounting, the asset protection, the super, and then build that model.
So what I'm hearing from you, Ken, is retirement isn't really a winding down period. It's just another investment phase, and one that requires planning, confidence, and actually the courage to stay in the game, which may be a little bit hard if you're not getting income from a wage. And that, I guess, means you don't have to chase high risk investments,
No.
but I don't think you can afford to stand still either. And I know that our smart clients and investors continue to make their money work hard for them through their retirement years. In fact, last weekend we were up on the Gold Coast and caught up with some friends, and I won't mention their names because they listen to this podcast, and they retired after coming to Wealth Retreat over a decade ago, and they're still comfortably living off their property portfolio because they understand risk tolerance, they have a contingency plan for volatility, and they stay focused on the long-term goal. So I think that's important. Now, if you're unsure how to adjust your investment property strategy for retirement, I suggest you speak to a professional, somebody who understands, I think what you just learned, if you heard Ken today, is both financial goals and property market. It's two different things that you've got to meld, and that's exactly what Ken's team at Metropole Wealth Advisory do, helping investors create, protect, pass on their intergenerational wealth at all stages of life. Ken, I know you've got a unique team and you're in an interesting position, different to other. So while you're an accountant, you don't want to do people's tax returns. So what do you do strategically?
Well, we help people understand what they've got. Are they using it to the maximum? And then put in place strategies to either fix, improve, or give them a new way to think of things. So we have a very holistic view of the world where we look at accounting, tax, asset protection, estate planning, financial planning, and then we act as the bridge between them and their specialist. So we would talk to their accountant or their lawyer. So nothing is lost in translation. And that's where our clients are getting the clarity and the comfort that the right questions are being asked and a no BS answer is coming back.
Interesting. So again, if you're interested, I'll leave a link in the show notes. Go to metropole.com.au and have a complimentary, obligation-free wealth discovery chat with one of our wealth strategists, but mention to them that you heard Ken on this podcast and you'd like to have a chat with him about things. Now, Ken, if there's people listening to this in their 50s, 60s, who are feeling unsure about whether their portfolio would support their retirement lifestyle, what's your advice to them? Where should they start?
They got to de-risk it. They got to make sure. So they got to start off with understanding, what do they have? Are they the best assets? Is it the highest and best use of that money that's locked up in that property portfolio? How is it being used and what are the alternatives? And from there, understand their estate planning needs and super. And all of a sudden you start to build, if you like, on very solid ground, how to maximize what you've got for longevity and then how to pass it on.
Right. So as we wrap up our chat, thank you so much, Ken. I hope that our listeners and viewers have recognized that retirement is not the end of the investment journey, as a lot of people thought, but simply the start of a new phase. So you might stop working, but your money shouldn't. I think you've heard now Ken and I speak about the real risk facing retirees, not the market volatility, but the slow and silent threat of inflation. It's been around since we first invested over 50 years ago, Ken, hasn't it?
It
And
certainly
that's
has.
created a growing cost of living. And I think one of the dangers is actually being a bit conservative too early in your investments if you're going to be living so much longer. And clearly what worked for you during your accumulation phase won't necessarily serve you during your retirement years. But that doesn't mean you've got to throw away your entire strategy. It means you just got to adapt it. So retirement requires structure, flexibility, a long-term mindset. You've got to have good cash flow buffers, a well-managed property portfolio, the right financial framework in place. That way you can enjoy the lifestyle that you've been working so hard for in those early years, but still have money to quietly keep growing in the background. And at Metropole, that's what we do. We help people just like you, investors who've done well, but want to ensure they're going to be able to transition into the retirement stage and beyond. So whether you're already there or planning ahead, remember, the right strategies to keep your money working for you so you don't have to. Thanks for your time today, Ken. Look forward to catching up again real soon.
Thank you, everyone. Thank you, Michael.
If you're a regular listener or viewer, you know I have a podcast trivia quiz, and each week I give away 3 copies of one of my best-selling books. Michael Yardney's Guide to Investing is the one I'm currently giving away, and so therefore I'm going to ask you a question in a moment and leave your answer at propertytrivia.com.au. It's been fun seeing all your answers, and thanks for the comments people are leaving as well, and it's been a pleasure giving away these books to the lucky winners. The question today, I think, is a reasonably easy one. Which property-related tax is often referred to as a wealth tax by critics? And I've used that term myself. Go to propertytrivia.com.au. I'll leave a link in the show notes and leave your answer. And even if you listen to this show a little bit late, don't worry. Your entry is still going to count, because everyone who enters the also gets a copy of a new report I've just written. propertytrivia.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I want to share with you something that I've noticed after decades of being involved in investment and in business. I've found that the best opportunities in life rarely come gift wrapped with a big sign, "Hey, this is it." They don't look like wide open doors. They look like tiny cracks, almost invisible to everybody. Maybe it's a chance to buy when others are fearful. Maybe it's a chance to learn a new skill before the world realizes it's valuable. Maybe it's a relationship, a deal, a property, something that doesn't seem significant yet. But the challenge is these tiny cracks are easy to dismiss. They don't feel certain. They don't feel comfortable. Spotting them takes awareness, paying attention to subtle shifts in the market or in people or in yourself. But capitalizing on them, now that takes courage, 10 parts courage, in fact, because the moment you move through that crack, you're stepping into the unknown. You're taking a risk, and most people, they hesitate. They wait for proof or for the door to swing wide open. But by the time the door's open, it's often too late. Everybody's walking through and the advantage is gone. So here's my challenge to you in today's mindset message. Where in your life are there tiny cracks right now? What opportunities are you seeing faintly that you're tempted to ignore? And most importantly, you have the courage to step through that tiny crack before it's obvious. Because the truth is, every big win starts with a tiny little crack and the bravery to squeeze through it. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?